I just read in the news just this afternoon that Geregu Power PLC, the company that the billionaire investor Otedola sold the majority of his shares because he said he wanted to invest in Dangote Refinery. Well, I read this morning that they have defaulted on their 40.09 billion Series A senior unsecured bond. Like they have missed both its eighth semi-annual coupon obligation and its scheduled fourth principal bullet payment, according to an updated listing status published by FMDQ Securities Exchange. How does this one concern us? Ah, Lord Jesus. It leads us to a conversation that I have been meaning to have. Which is better for you as a young investor, as a fledgling investor, as a new investor? Is it better for you to invest in corporate bonds, or is it better for you to invest in federal government backed bonds? That is what we're going to talk about today. If this is your first time of meeting us, my name is Daisy, and this is Growing Wealthy with Daisy, where I take you through my investment journey with the hope that it inspires you and it helps you to avoid the mistakes that I have made, because I have made a lot of mistakes. And one of the mistakes that I made was this comparison between commercial bonds and federal government bonds. Now, the whole reason we're investing is because we want to make money. Abby? Yes, now, we're in this to make money. So when I started experimenting with bonds, of course, I started with the safest bond there is, the federal government backed bond. But along the line, I got exposed to commercial papers and commercial bonds. And these ones tend to have a higher return on investment, higher percentage compared to your federal government bonds, compared to your federal government savings bond. And sometimes it is extremely attractive. Every day we wake up to a new commercial paper being you know being brought out by this company or that company. We see it in our investment platforms, we see it on our apps, we see it on the news, and we see the tempting returns: 22% per annum, 23% per annum, 25% per annum, compared to government bonds. We can't even access government bonds because how much do we have? But we can access the federal government savings bond. And right now, federal government savings bond is 14.9%. So you're comparing 14.9% with a commercial bond that is offering you 19%. Does it not make more sense to take the 19%? That is what we're going to talk about today, because the payoff is actually risk return. In one of our earlier videos, we have talked about the risk return trade-off, and and we are seeing it playing out live. Now, those are people that invested in the Geregu Power bond. Obviously, the bond at that time was issued at 14 point something percent, which was way higher than the federal government bonds at that time. So it looked like a good buy. But now we have seen them defaulting. And if my money did there, by now I'll be panicking. Of course, investors are panicking. So let's get down to the nitty gritty. As a young investor, as a new investor, should you invest in commercial papers, in corporate bonds, or should you save your money, hedge your money in a federal government savings bond? Let's look at it critically. Now, there are certain factors that you must look at when we talk about this risk return trade off. But before we look at these factors, you need to remember that when you're lending to a company, remember all bonds are debt. There are two types of instruments. There are debt instruments and there are equity instruments. Equity is ownership. Debts are, you're loaning your money to somebody. So when you're buying a bond, essentially you're giving a loan to either the federal government or to the corporate entity. So that is what a bond is. So when you lend money to a company, you take the credit risk. But when you lend to the federal government, you take a sovereign risk. Take a credit risk is based on the company's ability to pay back, okay? While a sovereign risk is based on the government's ability to pay back. So let's look at the factors that differentiate corporate bonds from the federal government securities. Now, the issuer, of course, of a corporate bond is a company, while the issuer of the FGN savings bond is the federal government. Now, when it comes to credit risk, the credit risk is way higher in corporate bonds compared to savings bonds, the federal government savings bond. Are we saying that there is no corporate risk? There's no risk with the FGN savings bond. That's not what we're saying. But we're saying that when you're comparing the risk, it is riskier to loan to a company than to loan to the federal government. Default risk. It is very, very possible for companies to default on their payment, as we saw in the Geregu incident. But when it comes to the federal government, I have not yet heard of the federal government defaulting on their savings bond. I've not heard. Maybe it's possible, but I have not heard about it yet. So it is generally lower than that of a company. Expected returns, of course, the higher the risk, the higher the expected return. So for the companies, the expected return is higher than that for a corporate or for a federal government savings bond. Income, yes, it is usually by a fixed coupon. So for this one that we're talking about, the Iregu bond, it's a semi-annual coupon payment. That's twice a year. For the federal government savings bond, it is a quarterly payment. That is 4 times in a year, which I like because it comes like salary. Anyway, diversification. Now, corporate bonds can can expose you to specific companies and sectors, while the federal government savings bond, you're only exposed to sovereign debt. So the exposure is larger in corporate bonds than in the federal government securities. Liquidity. It can be thin depending on the issue, but the liquidity of the federal government savings bond is generally better. They say generally better, but even now it's not that liquid, but I think it's much more liquid than the corporate bond. The amount of research that you need in order to invest in a corporate bond is way higher than that of the federal government. What am I doing about the federal government now? I don't need to see their sheets or anything. It's the federal government, they will pay. But the company, you have to see how they performed last year. You have to look at their profitability ratios. You have to look at their earning per shares. You have to look at their revenue streams and all that. A lot of fundamental analysis goes into picking a commercial bond, and it's really a lot of work. So potential capital gain or loss, yes. This one is important. As we are seeing, companies can default and you can lose your capital. But when it comes to the federal government savings bond, the only way you lose your capital, you lose your coupon payments, is if you sell early. The only way you lose your gains is if you sell early. And that's it. Minimum investment. It varies considerably, but one thing I have noticed about most commercial papers, most commercial bonds that are being issued, is that you need a minimum of 5 million naira to invest. So I have noticed that a lot of companies, a lot of organizations, they band people together in order to be able to invest in these corporate bonds. But when it comes to the federal government savings bond, you need only a minimum of 5,000 naira to be able to invest. Now, I would not advise you to use 5,000 naira and invest in FGN savings bond. I mean, how much is the coupon payment that you receive now? It's not plenty now. But if you have like 100,000, 500,000, a million naira, it is easier for you to buy a federal government savings bond than to buy a commercial bond. And who are these bonds best suited for? Now, if you are an experienced investor and you have the money, I think uh, a corporate bond may suit your risk, level, your risk tolerance. But if you are a young investor and your reason for investing this money is to preserve your capital, then I think the federal government savings bond would be a better bet. But you have to understand one thing is that the bigger the risk, the higher the potential returns. So corporate bonds always offer better um, interest rates than the federal government savings bond. Federal government savings bond right now is 14.9%. Corporate bonds that I'm seeing online are 18%, 19%, 20%. I even saw one 22% recently. I did not buy a share, but I saw it. But let's understand that this thing is not free money. The market is saying that if you lend me this money, because I am riskier than lending it to the federal government, I will pay you more. So that's just it. So the additional return is what we call a credit spread. So the credit spread of corporate bonds is way larger than that of the federal government savings bond. But when it comes to the major risk, which is default, we know that the risks of default for corporate entities are higher than the risks of default for the federal government savings bond. We know that. So, but it's not all bonds that are equally risky. So I cannot just tell you that corporate bonds are risky and so therefore you should not invest in corporate bonds. No, there is a spectrum. So the one with the least risk on the spectrum is federal government securities, like the federal government savings bond. After that, you have the highly rated corporate bonds. Remember, their interest will not be very high, but it will be higher than the federal government because there is more risk involved. And after that, we have what they call investment grade corporate bonds, which are still higher. And then we have the lower rated but higher yielding corporate bonds, which some people commonly call junk bonds. And then we have distressed debt, which people buy for pennies on the dollars, but it's people that can absorb the risk of losing their money. So the further down the spectrum, the more riskier it is, but the more potential return you can get. So I'm not saying that corporate bonds are so risky that you should not invest money. On the contrary, I'm saying that you should understand the kind of risk that you are taking and know if you are in the best position to take that risk. So if you haven't subscribed yet, that is risky. Click on the like button, subscribe, and in our next video, we're going to talk about the federal government savings bond and we're going to delve into how you can use it as a pocket to preserve your capital. Remember, we use equity to grow wealth, but we use debt like federal government bonds and corporate bonds and other securities to preserve our capital. So thank you for watching. Please like, share, subscribe, and I'll see you in the next video.